Retirement Podcast, where we share real-life stories and strategies that we've used to help hundreds of families retire with confidence. Your host is certified financial planner Jim Cox of McCarthy Cox Retirement and Estate Specialists. McCarthy Cox embodies small-town midwestern values and is dedicated to building better tomorrows.
Welcome, everybody, to another episode of Toast to Retirement. My name is Jim Cox. I am the managing partner of McCarthy Cox Retirement and Estate Specialists here in Marysville, Ohio. And today with us is Mark Finney, my business partner and friend and our chief compliance officer.
Hello.
His last video was about compliance, I think, right? Wasn't it a little bit?
Oh, riveting stuff.
Yeah. This was a little bit more of what you do the majority of your
Correct.
time, right? Which is more financial planning related.
That's right.
We thought we'd do a brief podcast, vodcast, whatever we're calling this at this point, however you're listening or seeing us, on the big, beautiful bill.
It's a big one.
It is a big one, but I hate the name so much because you bring this thing up with clients because you can't not make yourself sound like you're a Trump, like you want to do a Trump impression when you're like it's a big beautiful. I can't do one. It's terrible, but it's such a terrible name. Like I hope we can come to a different name where we start to talk about this and not in the big beautiful bill like something else. I don't know. I know it's
BBB.
Is that the industry's going to go with BBB?
There we go.
BBB bill. Anyway, but so Mark, as you know, there's been a number of things that have changed, but also things that are now staying the same. We're going to stay away from the politics of it, right? It's a divided bill, just like the president himself is very divisive. And so we're going to stay away from that. We're just going to talk about the tax ramifications and what's inside that bill, as specifically on the personal finance side of things, right? Mm-hmm. Where we work primarily with people very close to or in retirement, and so some of this does impact them.
Absolutely.
And pretty much anyone really is going to be impacted because of the changes in here.
Yeah, and my quick disclosure, because I have to be the guy to do that. We talk a lot about tax strategies with the families that we work for. It's a huge part of financial planning. There can be some big implications on making some smart choices earlier in life and later in life. We got to stop short of giving explicit tax advice. So we're going to keep this pretty high level. If you're one of the families that we work for, call us, talk to your advisor. We'll walk you through how it likely, is going to change things for your family and your plan. We got to defer to accountants and CPAs for explicit tax advice and guidance, but yeah, we're going to touch on a number of kind of the high level bullet points here. So
I love it. I love it.
Doing my job.
Thank you for keeping us compliant for sure. That's great. As we know, I mean the big thing here is the tax cuts that were implemented in Trump 1.0, right? That were about to expire this year.
Yeah.
Are now extended.
Yeah, and so-called permanent. And so, most of the brackets were going to go up 3% or so. Like, for instance, the 12% bracket, a lot of people we help find most of their money in that bracket was going to go up to 15. So this act
22
is...
to 25.
20, yeah, exactly. Yeah, so this act is going to preserve those previous cuts from 2018, I believe.
Which, in itself, I think is a good thing.
Yep.
Just because it was going to be a tax increase, it's weird how they did it before, where in the 1.0 version of this, the corporate tax cuts were made permanent, but the personal tax cuts were meant to sunset. And here we are, and now they are permanent, right?
So-called permanent, yep.
Well, that's
as
true.
Permanent as anything else.
That's true. Until we need to adjust them. And
there we go.
The other thing would be that the big change that happened, which I think, with all due respect to the divisiveness of this bill and the previous bill, a lot of people benefited, I saw, on the easier tax filing.
Sure, short form versus long form. Yep,
and
absolutely.
that's become permanent too, right? Yep. Where the standard deduction got increased
It's-
significantly, so people don't
Yeah.
have to try to itemize everything.
Yeah, now it's enhanced even further. Yeah, so $1,500 more for joint filers, up to $31,500 on standard deduction, for instance, next year. So
And that's that's married filing jointly, right? 31,500 standard deduction.
Yeah.
Right. So that encompasses, you don't have to worry about your charitable donations unless they get, everything else becomes above that.
yeah, it's a big deal.
On top of that, one of the things that really impacts our clients is if you're over 65,
Yeah.
there's a new tax deduction.
Yeah. Now this one's temporary, but it's basically an added deduction. So people over 65 get another $6,000 per filer, basically added on to the standard deduction. That one does have an income phase out. So joint filers, for instance, over 150,000 of adjusted gross income would phase out, but that's going to impact a lot of people in a positive way. Now that one is through 2028, so we'll see if it.
So the next
gets
couple of
extended.
years, we know we at least got that, and
Yeah.
that's additional
deal.
12,000 that stacks on top of the 31,500.
Yeah.
So if you're over 65, married filing jointly,
Yep.
I mean, this is a pretty big deal.
Absolutely,
Pretty big tax
yeah.
cut for the over 65.
Yeah.
So there's been some, I want to kind of clarify, because there's been a lot of misunderstanding about that specific piece, because the marketing behind it, even the Social Security Administration themselves put an email out that was misleading. It made it sound like Social Security benefits are no longer taxable.
Yeah. It's not the case, unfortunately. They fell short on that one.
Yeah, that didn't pass. But what they did was they're still trying to use that marketing language, I guess
Yeah.
I would say. It's a $6,000 per individual deduction, right? That stacks on top of the 31.5. Well, when you do the math and you say, okay, Social Security is going to come in, and what that meant was for I think 90% of people over age 65, that would be the equivalent of not paying taxes on their Social Security benefit.
Yeah.
But it's not paying.
Yeah.
You're still paying tax on Social Security. It's just not.
Yeah. This all just happened
Yeah,
last week, and there's already misinformation and confusion. So call us. We'll help you figure it out.
Yeah, I mean, even that one that Social Security came out had me actually thinking the wrong thing too for
second guessing me
about
too. Yeah.
6 hours until I found out that I was wrong. I was like, well, no, I've got Social Security saying this, and they're like, no, it's just. And I'm like, okay, thank
I got
you for
excited too.
appreciate. Yeah, exactly. I was like, that's huge. No, so but yeah, like you said, it starts to phase out at 150,000 of, is it modified adjusted gross?
I
think so,
believe, I believe.
Almost everything's
Yep.
modified adjusted gross income.
Yep.
So
That's for joint filers. Yep. Individuals are a little bit less, 75,000 for individuals.
okay.
So.
But it all the way, you still get something. You just don't get the full 6,000 if you make over 150.
That's my understanding. Is
It's
when
just
the
all
phase
the way
out.
all the way to 250, I think. So,
Yeah.
and then at 250, there's you lose the 6,000 per individual.
Yeah.
Other cool thing, right? The tips.
Yeah.
Overtime.
Yeah.
You want to speak about that?
Yeah, so some overtime and tipped workers are going to see a tax break as well, so that's going to be really beneficial, obviously, for a lot of folks in those kind of jobs. So tipped wages can be deductible up to $25,000. There's some income limitations there too. $150,000 income individual, $300,000 for joint filer, and then overtime wages. The deduction is going to be capped at $12,500 for an individual, $25,000 for a couple, same income limits. So another one of these temporary policies through the end of 2028. So.
And one of the things I learned about that is those are below the line tax deductions.
Okay.
So a lot of people are saying, again, just like the Social Security thing, oh, I don't have to pay taxes on tips. You get a tax deduction below the line on that. It's not an above the line, so which means you do have to report it.
Yeah.
So it does go onto your AGI.
Yeah.
And also, therefore, then also would be like, it is taxed for Social Security and Medicare. So that has to go through payroll and everything else.
That's right.
So, I mean, it's still good. It's
Oh,
still
yeah,
better
yeah.
if you're a tipped employee, it's still better than it was beforehand.
Yeah.
If you're an overtime employee, it's still better than it was beforehand. But again, there's a little bit of like nuance
Absolutely.
there.
Always.
That that you have to understand. It is still reportable and what have you. You know what else was interesting? I read Mark, was they capped your losses for gambling at 90%. So you could theoretically, like, you bet $5,000 and you win 5,000, and then you bet another 5,000 and you lose 5,000. So you have zero, right? But it's capped at 90%.
Oh.
So there's phantom income
Yeah, sure.
of $500 like that you would have to report as income on your tax return, even though that's not actually what happened. But that's a different change, and nobody's talking about that yet.
Nobody's talking about that.
If you're a sports gambler, I think that's important. I mean, we don't encourage this.
For the record, another disclaimer.
I think it's important that we talk about that. We don't encourage gambling, period. But I think a lot of people clearly are doing that, and that's a change in the tax code that a lot of people I don't think are very familiar with. But we'll have to kind of deal with that. Also, a change on this is the SALT. Tax deductions. And so you want to speak a little bit about that?
Yeah, so that's state and local income tax. So that's going to rise. So, another positive thing for a lot of people. So it was a $10,000 cap that was put in place back in 2017. So that's going to increase to $40,000, and then it's going to be increasing 1% per year thereafter. There's another phase out there, but it's even higher. So for joint filers, they don't get phased out on earnings until we're at $500,000. And so it's another temporary provision that's set to end, this one a little longer, in 2030, where it'll, at least at this point, revert back to the $10,000. But yeah, for the next 5 years, that's going to be helpful too.
Well, where people were really complaining on the 1.0 bill, where people like in New York and California, the places that with really, really high state local taxes, that's the biggest win. And if I had to imagine politically, that was like, to get more votes from the representatives of those states, because they were really hurt over the last 8 years or so, with that cap of 10,000. So again, this means less taxes, which ultimately I'm in favor of.
Yeah.
Now, I don't have too many clients that this next provision applies to.
It's exciting.
But the estate tax has been increased significantly, the exemption before anyone would have to pay. Do you want to talk about that a little bit?
Sure. Yeah, this one's really interesting. So at the beginning of my career, which, was 20 years ago, it's not, like we were at about $1 million on this. So now for a while we've been at like 12 million. Now we're going to go to 15 million for individuals, 30 million for joint filers. This one is supposedly permanent and then going to continue to be adjusted for inflation annually. So, I mean, it's a huge number now on estate and gift exemption, like Jim said. So.
And it was, I believe, second largest tax in the IRS code.
Yeah, it's like
right?
40%.
Behind like not taking your required minimum distribution correctly. Exactly. It was like 50% penalty.
Yeah.
And this one was a 40-something percent estate tax on. And when we started our career, I believe it was $1 million.
A lot of people fell into that.
It was a lot of people that ended up having to pay estate taxes.
Had to get crafty
and we did a lot of
trusts.
Yeah,
we
did a lot more work with estate planning back then.
Yeah, for sure.
Clearly, there's some folks that still have to address this need with a financial planner. We'd love for you to call us if you have any questions on that. We'll walk you through some of those strategies that exist. The one other change is a lot of this, the EV changes, right? The electric vehicle and the green initiatives that were put in place. They've been around for a while now, but they have a phase out coming. Yeah,
so I mean, with any act, there's winners and losers. So yeah, this would be one that some people probably wouldn't be happy about. But yeah, the EV and clean energy, like home improvement credits, are going to end this year. And then, so with vehicles, I think those are going to expire on auto purchases made after September 30th of this year. Home energy improvements completed by December 31st are eligible, but then after that, those are done. So, the bill itself has a ton of different provisions.
Any other ones that you can think of that?
Well,
really-
while we're talking about cars, like auto loan interest is
Oh,
kind of
yeah, that's
interesting.
right.
So
That's
you can
great.
actually deduct auto loan interest up to $10,000 for some new car purchases. So it's a temporary position that's going to go on till 2028 again, like some of the rest of these. But apparently, the car has to have a final assembly in the U.S. So that'll kind of
Okay.
be interesting to see how that works out for some people. But
Again, the tax tail doesn't necessarily wag the, purchase dog, let's
Sure,
say,
sure,
right?
sure.
I mean, if you need a car, you're going to need a car, but it's nice to have.
yeah, it's another.
And it
little
might
benefit.
influence you to buy a little bit more, American assembled vehicles.
Probably the thought behind the bill, yeah.
Um,
Absolutely.
And here in Marysville, Ohio, I believe, we haven't necessarily researched this, but I believe that we are looking at the Honda Accord and things like that being manufactured here in Marysville, Ohio, that would qualify under that tax exemption. So
Yeah.
there will be a lot of local people that will benefit from
It's
that tax
exciting.
deduction.
Absolutely.
One thing that stood out to me was a couple of things. One was the HSAs, the healthcare savings accounts.
Yep.
They've been around for a while, and they're a very powerful tool. You can put money into an account on a tax deferred basis, right? You get your tax deduction basis, and then if used for medical expenses, it's tax free when you pull out, right? So it's like
Powerful.
it's more powerful actually than the Roth IRA, which has to go in after tax money.
That's right.
And so whenever we have a client who has, a high deductible healthcare plan, that's what you have to have, a high deductible healthcare plan.
Yeah.
It makes sense to start an HSA for that particular client because of the, and then if we can try to build that up for the extra out-of-pocket costs in retirement.
That's right.
But one of the cool things was they made it eligible for our clients in retirement. They had not been eligible for an HSA if they were on Medicare.
Yeah.
Just period, blanket, no one in Medicare allowed. And that created a little bit of an issue, as you know, like at age 65, should they stop their HSA? When should they stop their contributions and stuff like that? So the cool thing here is if the client chooses through whatever broker or whatever they want to use for healthcare decisions, if the client chooses to be on a high deductible plan in Medicare, because there is Medicare options out there that are high deductible plans, you don't have to be, but if you did, you could actually continue to do an HSA.
Yeah.
So will they do that? I don't know. One of the cool things about being on Medicare is having that old school, like really, really healthy benefit.
Yeah. Like
for
no
medical.
deductible.
Yeah. I kind of like that, but at the same point, I can see it benefiting some folks.
Sure.
Especially, the healthiest of the, young, like 65 to 70, 75-year-olds.
Yep.
Also on the younger part of this, my understanding is that families that earn less than, I believe it's $150,000, the amount that they can contribute to an HSA. I think there's some qualifiers, so I want to make sure that everyone understands that they need to come in and talk to us about that, or talk to your financial professional about it. But I believe that the amount that they can put into contribute into an HSA might double.
Mm-hmm. I've heard that's going up.
Okay,
Yeah. Mm-hmm.
so.
Yep.
But again, there's income qualifiers and all that stuff, and that's married filing jointly, I believe, on $150,000. But
Yep.
how about there's some 529, which is the education savings accounts that are out there. There's some changes on that. Do you want to speak to that? Or?
Yeah, it sounds like the K through 12 especially is going to see quite a bit more that can be used for those kind of, like, for instance, private elementary school expenses. So that was going up significantly.
It was $10,000, I think, in the past that you could pull out of your 529
tax-free.
on a tax-free basis for those, and now I believe that's gone to $20,000.
Yeah, double. Yeah.
So again, for anyone in the
deal.
private education space, that can be of a significant benefit.
Oh yeah.
And then also you can use your 529 now for advanced like certifications. So for us, we are certified financial planners. We could use our 529 plan if we had one for ourselves to pay for those advanced credentials or
CPAs also.
CPA.
Yep.
Sometimes employers help with that, and sometimes they don't. And so to be able to do so on a tax advantage basis, I think is something that if you're a young person and you're looking, and where to save money, and that just becomes that much more powerful of a tool for you.
Yep.
And anything that encourages, education. I think with
yeah.
the robot revolution that we're gonna see down the road here is important. But okay, what'd I miss?
There's a few other smaller aspects of this, and then certainly like we can talk about the other end of the spectrum in terms of like cuts that have been made to Medicaid if you have questions about that. There's a number of business and business owner items on there.
So
defense
my
spending,
favorite
all that.
thing is
Yeah.
we're back to, for this year anyway, we're back to 100% bonus depreciation.
Yeah.
So, which means if you're a business owner and you buy, let's say, I don't know, I'll pick a random person that might, I don't know, let's say own a golf course. I don't know, just saying. And you want to buy a new mower this year, you get to depreciate 100% of the cost of that mower off of your earned income for this year.
That's great.
So, yeah, I think I think that's going to, like it did last time, it really did spur the economy. Do you remember how we had,
absolutely,
in the 1.0 bill of this, we had a quarter or two where GDP went above like 3%.
Yeah.
And they said it couldn't happen ever
Yeah.
again, right? Because we kind of are in that low twos of GDP, which is good, how big we are.
Yep, normal.
Of a United States economy. I think we could see it again. I think, it spurs a lot of people to say, hey, what do you mean I can deduct 100% of the cost of this in this year? Like,
sure.
It definitely could make people go, oh, I was going to hold off till next year. Maybe I'll do it this year.
Yep, I can see that.
Yeah. So that's a cool thing. And then there's other, like you said, some other business things. I don't know if you want to talk about that or not, but there's other things in there that have been a business owner. I would think if you're a business owner, you should be having financial
absolutely
planner support to see what's in this bill and see how it affects you.
Yeah.
Come on in. Make an appointment with your advisor here or wherever you are. We do have clients, I should say, my marketing pitch, right? We do have clients in, well, you're the compliance guy. What is it, 26?
26 different states.
26 different
believe
states.
Believe it or not, yep.
So I thought that was the number, but I didn't know if we added any recently.
Yeah, it's half the country. Yeah.
Almost, a little over half.
A little over,
yeah.
Pretty cool.
Well, Canada might be the 51st state. So.
Oh, boy. Now we're treading in dangerous waters here, Jim.
So yeah, the reality of the situation is this podcast is called Toast to Retirement, Mark, and we always pick something to toast with, right? Well, the big beautiful bill is a whatever you want to call it.
Audacious.
It's audacious. It's Trump,
sure,
right?
Sure.
The name of this thing. So we thought we would do. If you're a champagne drinker, this is one of the best champagnes out there. I've had it before. My wife is going to kill me because she loves this stuff.
Oh, you stole it?
Yes, 100%. I stole it. So,
oh boy.
But I thought, what better, right? Like its name is Rich. Vuv of Vuv, I think is the appropriate Vuv. I know. I just learned that like less 6 months ago.
Too fancy for me.
Vuv Rich, and it is a very, very good champagne. And I will go ahead and try and attempt to open this champagne without destroying. I have meetings this afternoon. I hope I don't ruin.
I didn't shake it, I promise.
Yeah, I know. Oh, that would be bad. Is that why you asked me to open it?
Oh, here we go.
All right.
The moment.
Suspense.
Perfectly done. Impressive. I would have sprayed it everywhere.
All right.
Good job.
Thank you.
Cool. This is a little fancier than the last one you had me on. We did boxed wine. That's more of my speed.
That's fancy right there. By the way, that wine
surprisingly
was really
good. Yeah.
I told everybody about that.
It's a staple now.
This is way better than I thought.
You're serving it.
sponsored
You're
by that.
selling out at the golf course on that stuff, probably.
Well, we might not still have that, but we should though. It was not bad. All right. Do you have a good toast in mind?
Never. How about you?
When I didn't prepare one, so when forced to, I always go back to my my Irish roots, which is
good.
May the road rise up to meet you, may the wind be always at your back, and until we meet again, may God hold you in the palm of His hand.
Fantastic.
Sláinte. See?
Oh,
Isn't that great?
it's really good. Yeah.
It's really great.
Thank you, Faye.
Thank you, Faye. I will buy you another one at some point, hopefully. That concludes our podcast. I appreciate your help on this. Try to get it timely. There's still moving parts, and we are still learning.
Breaking
I'm putting
news,
your
yeah.
compliance hat on. We are still learning a lot about the details of all of this. Some of it's easier than others, but there is still some misinformation happening out there based on the selling of the package, if you will, to the American public. So, but we're here to navigate these waters. Things are constantly changing. They change every year. This one's a bigger change than we've had in a while. Yeah. But that's why we continue to meet with our clients on an ongoing basis. This is a service-based relationship. It's an ongoing relationship. It's not a transaction. And we encourage you to, we'd love for you to think about us if you're looking to retire in the next 5 years or are already retired and looking for maybe more professional assistance outside of that. But we thank you for your time today, and hopefully we'll see you next time.
Feel free to share with friends and family, and follow McCarthy & Cox Retirement and Estate Planning Specialists on Facebook and LinkedIn. Check out the podcast tab on our website, www.mccarthyandcox.com, where you can find links to all the episodes of Toast to Retirement. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general information purposes only and does not constitute either tax, legal, or financial advice. Please consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.